For our final session, I'm excited to talk to Morgan Housel. Hi, Morgan.
Good morning. Thank you so much for having me.
Morgan is a partner at the Collaborative Fund. He has been writing about investing for over a decade, and we were happy to see him consolidate many of his insights into a book called The Psychology of Money, which we recommend to everyone. Morgan gives a wonderful perspective on how to think about money and investing. Thank you for participating, Morgan.
It's certainly an honor to be here. Thank you.
Morgan, at the beginning of your book, you talk about a janitor who died a millionaire. He didn't win the lottery or inherited the money. He simply saved, invested, and took advantage of compound interest. You contrast his success with a Harvard MBA who went broke despite having way better access to training and a much more profitable career. You go on to say that only in finance can a totally untrained person outperform someone who had access to the best schools. Why is that?
Well, it's so true in finance that even if you are the smartest investor in the world, and let's say you went to Harvard, you went to Oxford, you have the best education, you understand finance better than anyone. But if you lose control over your ability to control greed and fear, if you panic when the market crashes, if you get caught up in a bubble when the market is surging, none of your intelligence, none of your education is going to matter. I think there's a pyramid of investing skills, and the base of that pyramid is investing behavior, by which I mean your ability to control greed and fear, your ability to take a long-term mindset, how gullible you are, who you trust and who you seek your information from. That's what investing behavior is. And until you have mastered that, none of the intelligence and analytical skills that we associate with being smart really matters until you have mastered the behavioral side of it. It actually is somewhat similar to, say, health, where you can be the smartest doctor in the world. You can have gone to medical school at Harvard, but if you are someone who eats a lot and doesn't exercise and smokes and doesn't get a lot of sleep, you're not going to be very healthy, despite how smart you are. So I think it's actually similar to that, but everything we know about investing is that intelligence does not matter until you have figured out your own behavior.
You often say that the key to investment success is not earning the highest returns. It's about earning pretty good returns for the longest period of time possible. Is that the underappreciated secret to Buffett's fortune?
I think it's definitely the most important secret in investing. And I say secret because so many people don't pay attention to it, but it's not complicated at all. If you understand how compound interest works, the variable that really matters, that makes all the difference, is time. It's just how long are you investing for? And so rather than as an investor asking, how can I earn the highest returns, which is the question that most people ask, the more important question is, what are the highest returns that I can earn for the longest period of time? And if you are someone who can earn average returns for an above average period of time, you will achieve extraordinary results. You will beat the vast majority of investors. And like you said, this is true for someone like Warren Buffett. He's one of the richest men in the world. He's the most successful investor of all time. And if you look at his net worth, the vast majority of his net worth was accumulated after his 60th birthday. Something like 90% was accumulated after his 60th birthday. And so if you think about compounding, that's just how compounding works. It's not something that takes place over 1 year or 5 years or 10 years. It's a lifelong endurance game. And the longer that you can stick around for, that's when the enormous returns come. To wrap this up, I think there's no more important skill that exists in investing than just increasing the amount of time you're investing for. And it's such boring advice and basic advice, but nothing works better in this industry than just being a little bit more patient. Nothing is more powerful than that.
You also say that there's no investment idea that works if you're going to abandon it at the first sign of trouble. If you want high returns, you must be willing to pay the price. What is that price?
Well, in investing, when most people think about the cost, just like anything else in life, if you want something nice, there's a cost that you have to pay to get it. Same in investing. And when most people think about the investing cost, the price, they focus on the fees, the management fees, fees to their financial advisors, things like that. And those are fees, but the biggest fee that you pay in investing that you have to be willing to pay to get the reward is putting up with and dealing with volatility and uncertainty. That's the cost of admission that you have to pay to get the rewards on the other side. And what's so important about this is that most investors, when they come across volatility and their portfolio falls 10%, 20%, 30%, whatever it might be, they don't view it as a fee. They don't view it as the cost of admission. They view it as a fine, like they did something wrong. And a fine means that you made a mistake. Like you're in trouble, shame on you. That's what a fine is. And I think rather than viewing volatility as a fine, rather than viewing it as a sign that you screwed up, if you can view it as the cost of admission for earning higher returns, then it's much easier to put up with and deal with volatility. But you have to be willing to pay it. If you're not willing to pay the fee of putting up with volatility and you panic at every time that you experience it, you're never going to compound your returns over time as an investor. You're never going to accumulate very much wealth.
As investors, we are all bombarded with news and speculations about the future of the economy, about elections, inflation, and etc. How do you think investors should deal with all these concerns?
I think it's always been the case in every historical period, in every country, that there are plenty of things to worry about. That's never not been the case, and that never will be the case. It will always be the case, no matter how strong the economy is, how strong the market is, that there will be a dozen things that you and I can list off the top of our head that are things to worry about and big things to worry about. I think a lot of this goes back to what we just talked about in terms of dealing with volatility and dealing with uncertainty. If you are a long-term investor, you are going to deal with periods of rising inflation. You're going to deal with periods of political uncertainty. You're going to deal with recessions and banking crises and pandemics, as we've all learned over the last 2 years. That's always going to be the case. And rather than asking the question, how can I avoid these? How can I get around them? How can I hedge them? I think for most people, the better answer is, how can I just endure it and put up with this uncertainty and volatility? And for a lot of people, that just comes down to constructing a portfolio and an asset allocation, the different, which is the trade-off between stocks and bonds and cash and gold and other assets that you might own, that will allow you to sleep well at night during this uncertainty. So I think if you are someone who is constantly asking the question, how can I avoid the bad news that's in the newspaper? That to me is kind of a red flag that you might be doing something wrong. And because a lot of the reason is because no one can necessarily predict what problems are going to afflict us in the future. Nobody a year ago was talking about a global supply chain that was going to be broken. And nobody 2 years ago was talking about a pandemic that was going to shut down the global economy for 2 years. No one was talking about those things, but they're what happened. There's a financial advisor who I really admire named Carl Richards, who says, risk is what is left over when you think you have thought of everything. I think that's so true in investing and economics, that the most risky news story of the next year, of the next 5 years, is something that you and I and everyone else can't even think about right now. It's going to be a surprise to everyone. And in that world, I think the best that anyone can do is say, rather than trying to predict what's going to happen and try to avoid it, is just trying to figure out, how can I become robust and durable in my finances so that I can put up with and deal with this uncertainty.
You wrote also that the best financial plan is to save like a pessimist and invest like an optimist. Can you explain that?
I think if you save like a pessimist, by which I mean you are saving for the idea that there's going to be a lot of bad news in the newspaper. There's going to be recessions and bear markets and pandemics and terrorist attacks and political collapses, like go on down the list. That's going to be part of our future, guaranteed. So if you're saving like a pessimist, you're just kind of creating endurance in your finances so that you can put up with a recession, maybe a job loss, maybe a medical emergency, whatever it might be. That's saving like a pessimist. But you also have to invest like an optimist. You have to invest your money, whether it's in the stock market or a private business, whatever it might be, with a long-term optimistic outlook, that people can solve problems and become more productive, and that we're all going to work together and figure out and overcome whatever problems are hurting us in any given moment. And that kind of dual personality, saving like a pessimist, investing like an optimist, seems contradictory. And it is. Those are contradictory skills, but you need to have both of them to do well over time. I mean, there's a difference between getting rich and staying rich. And I think that often goes overlooked. You need one set of skills to get rich, which is long-term optimism. And then you need another set of skills to stay rich, which is kind of short-term pessimism and conservatism. And I think it's rare that people can really master both of those. But it's easy to overlook that you need at least some of both elements like that, a saving like a pessimist and investing like an optimist, so that you can both get rich and stay rich over time.
In a blog post a year ago, you spoke about how you lost 2 friends in an avalanche when you were 17 and how that changed your behavior. You concluded by then thinking about how, when it comes to risk, tail-end events are all that matter. How do you think people should deal with tail-end events without getting out of risk altogether?
Yeah, first I would say what I mean by tail-end events is that if there are 100 different events, different news stories, 1 or 2 of them is going to matter more than all the others combined. So if you take any given set of news stories, a small portion account for everything that really matters. Just like in the last decade in the United States, COVID-19 and September 11th terrorist attacks is like the only news stories that really made a difference. Those mattered more than anything else. And so I think, how can investors deal with that world where once a decade, 1 news story is going to matter more than anything else? And it's kind of an out of the blue fluke event that has terrible consequences. I think people should save their money and have an amount of conservatism in their finances that does not seem reasonable. By that, I mean this. If you are only saving for the risks that you can think about, that seem reasonable to you, you are always going to miss the big risks that you were not thinking about. That was a surprise. So I think you have to have a certain amount of cushion in your finances that you can't even explain. And someone might say, why do you have so much cash? Why do you have so many bonds? Why are you being so conservative in your finances? And the answer to that question is, I'm saving for a risk that you and I and everyone else can't even fathom. Which again, if you were to go back to the year 2000, that risk that no one could fathom in the United States was that there was going to be a giant terrorist attack that shut the country down for a period of time, sent us to war, et cetera, et cetera. If we were talking about 2019, what's the big risk that you're saving about? Why do you have so much cash? It was a global pandemic that no one saw coming, very few people saw coming, that surprised everyone and shut down the world economy. You have to be saving for events that you cannot think about. And I think a lot of people only save for things that they can think about. I'm saving for a new car, I'm saving for a down payment on a house, whatever it might be. So I think you have to be able to kind of train your mind to prepare for things that you cannot even fathom. I think that's the only way to really survive a world where there are these out of the blue fluke events that change everything. That has been a key feature of all of history in the past and will be a key feature of our lives going forward. It's always going to be the case.
You wrote that one of the most powerful ways to increase your investment results is to save more. And one of the most powerful ways to increase your savings rate is to raise your humility. Why is that?
Well, for a lot of people, and I want to emphasize a lot of people, by which I mean not everyone, the amount that they save is really the gap between their ego and their income. And what I mean by that is, for most people, if you are achieving a baseline level of security in terms of food and shelter and transportation and taking care of your family's basic needs, a lot of what you spend above that level is just signaling to other people, to show people that you have a lot of that, to kind of show that you are valuable in the world and that you have a lot of wealth. So the clothes that you buy, the cars that you drive, the jewelry that you buy, a lot of that stuff is a social signaling mechanism. And therefore, if you are looking for ways to save more money, the way to do it is to decrease your ego, is to stop signaling to other people and wanting to show people how much money you have. The fastest way to have less money is by spending money to show people how much money you have. And I think if you kind of internalize that and take that seriously, then the best way to increase your finances is to decrease your ego and kind of more focusing on yourself rather than trying to signal to other people how much money you have, just using your own money to make yourself happier. And for a lot of this, the biggest reason by far, the biggest benefit of this is using your own money to gain control over your time. And most people, I would definitely say most people, use money to show other people how much money they have. They just want to show off how much money they have. If you can detach yourself from that and just use your money to give yourself independence and autonomy and financial security so that you can take the job that you want rather than the one that you need. You can live where you want, retire when you want, those kind of things. Giving yourself that level of financial independence that you can gain by lowering your ego a little bit and just having less desire to show off how much money you have, I think is probably the most powerful lever that ordinary people have to gain a lot of financial control over their lives.
Yeah, you say that no one is as impressed of your possessions as you are, right?
No one is thinking about you as much as you are. I got this idea when I was in college, when I was working as a valet at a very fancy hotel in Los Angeles. And people would come in driving their Ferraris and their Lamborghinis and their Rolls Royces. And I realized that never once did someone drive in that car. And I looked at the driver and I said, wow, that guy's cool. Instead, what I did is I pictured myself as the driver. And I thought, if I was the driver, people would think I'm cool. And that disconnect, that irony of like, I was not paying attention to the driver, but I assumed that if I was the driver, people would pay attention to me. Everyone kind of falls for that. And just the idea that no one is thinking about you as much as you are, I think that's the insight, that's the philosophy that I use to try to decrease my ego a little bit and have less desire to spend my money just to show other people how much money that I have.
Connected to that, another powerful take in your book is related to the concept of wealth. And in particular, the difference between being wealthy and having expensive things. Can you explain that?
I think being rich, in my definition, is the ability to buy a lot of nice stuff. You can buy a lot of nice house. You can buy a nice car. You can buy nice clothes. You have nice clothes. You can go out and spend stuff. That's what being rich is. Wealth is something very different. Wealth is the money that you do not spend. It's the cars that you did not buy. It's the homes that you did not purchase. It's money that you have saved up and have not spent. And this is really important because the quirk from this is that wealth is invisible. I can see the clothes you're wearing. I can maybe see the cars that you're driving, the home that you live in. That's visible to me. But I can't see your bank account. I can't see your brokerage statements. So wealth, as I define it, is always invisible. And this is really important because it makes it so that it's hard to have good financial role models because we really have no idea how wealthy or how broke most people are. And if you contrast this to something like physical fitness, your physical fitness is visible. If you are in good shape or if you're overweight, you can see that. But wealth is invisible. So it's much harder to have a role model and say, I want to be like this person. I don't want to be like this person because it's not visible. And for a lot of people, if you see someone driving a nice car, they're driving a $100,000 car, the only thing you know about that person's finances, is that they have $100,000 less dollars than they did before they bought the car. That's the only thing that you know. And since wealth is invisible, it just makes it very harder to find role models. And one other part of this is that you start to ask the question, if wealth is what I don't spend, what's the purpose of it? What's the purpose of having money if I'm not going to spend it? And to me, the answer to that question is really easy. It's having independence and autonomy and just being able to do what you want, when you want, with whom you want for as long as you want. Because you have so much financial cushion, you have independence. You're not relying on someone else. You are your own boss. You are financially independent. That to me is something that can give most people a really lasting and durable level of happiness in their life that I think should be the goal of more people. And it's only going to come from the money that you don't spend.
You mentioned stories in your book about people who couldn't have enough and ended up losing everything. Why is that such a common trap, and how can one prevent it?
I think it's really fascinating when there's this great quote from Warren Buffett that I really like where he says, if you risk what you need in order to gain what you don't need, that is just foolish. That's crazy. And there's so many examples of this, of people who are billionaires, some of the most successful people in the world, who got into too much debt, took way too much risk, and went bankrupt. And that's amazing. When you are, I can understand if you are broke and you have a starving child at home, and you go out and buy a lottery ticket or rob a grocery store, something like that, that I can wrap my head around because you have nothing to lose and everything to gain in that situation. But if you are someone who is very successful, you have a lot of wealth, and you're still taking so much risk that you're going to gamble away what you need and what you already have, that's crazy. And you would think reasonably, like it would make sense that the wealthier you become, the less risk you take, because you don't need to take risk anymore to gain more wealth. You've already saved some of it up. And so that to me is something that I try to think about quite a bit. Like as your net worth rises, how can you take a little bit less risk so that you are locking in what you have, what you already have? Not dramatically less risk, but just kind of stabilizing what you have so that you don't need to take more risk to gain it back one day. I think that's really important. A lot of this comes down to the concept and the topic of having enough money, taking enough risk, being satisfied with what you already have. And if you don't have some idea of what enough is, I think most people will learn about it the hard way. They'll take too much risk, or they will spend too much time on their careers and not enough time with their families, and they'll end up regretting it in hindsight, often when it's too late. So the definition of enough is different for everyone. My definition of enough money and enough risk might be different from yours, different from other people's. But if you don't go out of your way to ask how much is enough, I think I think that's probably the most important word that exists in financial planning. And you can still be ambitious and have goals to have more and want to grow your net worth. I do too. But if you don't have some sense of enough, I think it's likely to backfire on you at some point, and you'll look back at it with some sense of regret.
Great. And one idea related to the concept of enough, and that I think you do a great job of explaining in the book, is money's greatest intrinsic value. You already touched on this, but I think we need to get deeper on it. Can you explain what is money's greatest intrinsic value?
To me, my definition of it is giving you independence and doing what you want, when you want, with whom you want, for as long as you want. That's what money can do for you. But what's so interesting about this is that most people, if you ask them around the world, what does money do for you? The answer is really simple. Money lets you buy stuff. And that's great. Like I like nice stuff. I like nice homes and nice stuff. Like, I'm not saying live like a monk, but there's something else that money can do that is so overlooked, which is giving you independence. And this is everything that we know about psychology, is that one of the things that makes people very happy in life if they can achieve it, or makes them very unhappy in life if they don't have it, is just control over what you're doing and the ability to do what you want when you want. And so many people that don't have financial independence, don't have any, they're kind of on a paycheck to paycheck basis, are completely reliant on their employers, their bosses, 100% reliant for everything that happens in their life. And if they were ever to lose their job, then they're instantly in a precarious financial state. Whereas if you have just some level of financial independence, that does not have to mean millions of dollars. It can mean $5, $10, $20, $100. Every dollar that you save is a little bit of your future that you own, that belongs to you rather than belonging to someone else. So I think if we can go out of our way to use our money, to save our money, to gain financial independence and autonomy, rather than using it just solely as a mechanism to buy more stuff, I think that is something that can let people sleep better at night and actually make themselves a little bit happy in life. I'll end this by saying there's a great book from a gerontologist who I really admire named Carl Pillimer. And what he did is he asked 1,000 elderly Americans, most of whom were 90 or 100 years old, what they've learned about life. What has worked for them? That, you know, you've been around for 100 years. What have you learned about life? And there's a section of his book where he talks about money. And he mentions in his book that of the 1,000 elderly Americans that he interviewed, not a single one of them said they wish they had earned more money. And not a single one of them wished that they had worked harder in their careers. None of them wished that they had, had a goal to earn more money than their neighbors or something like that. Not a single one of them. But every single one of them, to a T, said, I wish I spent more time with my family. They said, I wish I was nicer to people. I wish I'd spent more time in my community trying to make the place a little bit better. I think that's like a big wake-up call. These are the people who have been around and lived longer than me and you. They've been around for 100 years. I have 100 years of experience dealing with money. And not a single one of them wished that they had earned more money. They just wish that they had spent more time with their family. I think if we can use our money to gain more independence so that we can spend more time with our family, spend more time with the people that we like and admire, more time in our communities, that's something that we can use money to actually gain ourselves a better life.
That's great. In your book, you tell the story of Rick Guerin, a friend of Buffett and Munger's, who might have been just as skilled as them at getting wealthy, but not as skilled at staying wealthy. What can we learn from Guerin?
Well, Rick Guerin was a very interesting character because he was an incredibly smart and talented investor of equal intelligence of Warren Buffett and Charlie Munger. And he was part of that trio. If you go back to the 1960s and 70s, there was Warren Buffett, Charlie Munger, and Rick Guerin kind of working together, interviewing CEOs, making investments together. They were a trio. And then after about the 1970s, it kind of split away. And Warren Buffett and Charlie Munger went on to become the most successful investors of all time. And Rick Guerin kind of faded away from that spotlight. And it was revealed a couple years ago from a guy who had lunch with Warren Buffett that what happened to Rick Guerin is back in the 1970s, he had a lot of debt. He had a lot of margin loans. He was borrowing money to buy stocks because he wanted to get rich fast. And when the market crashed, those loans were called, and he kind of was forced to sell his Berkshire Hathaway stock. And when Warren Buffett was asked about this, he had a really interesting comment. He said he and Charlie Munger always knew they were going to get rich. So they were not in a hurry. They were in no hurry to get rich. They knew it was eventually going to happen. It was inevitable. And Warren said Rick was just as smart as Warren and Charlie, but he was in a hurry. He wanted to get rich a little bit faster. So he was borrowing money to buy more stocks because he wanted to get rich in a hurry. That was how Buffett phrased it. And I think that idea of the more in a hurry you are, the more likely you are to blow yourself up. And the less you are, or the more you're willing to just say, look, I'm willing to get rich slowly. That's going to increase the odds that I'm actually going to get there. That is like the natural competitive advantage that most people have. The huge majority of individual investors are not smarter than the collective intelligence of the market. They're not smarter than Wall Street. They're not smarter than the hedge fund managers. They're not. That's just the truth. But if they could be a little bit more patient and more willing to get rich slowly over time, that's the competitive advantage that you have over the professionals. And it is so powerful over time because so few people are willing to do it. So few people are willing to get rich slowly that it is an advantage for those who actually can do it. And you don't need any special intelligence, any special education, any special information to just be a little bit more patient. So I think if you are that kind of person, again, who is willing to earn average returns for an above average period of time, that is your path to financial success in investing over time. That's the most reasonable path that ordinary people can achieve to get to that goal.
I totally agree. You say that people should strive to have a good sense of their future regret. Can you explain that idea?
I think when we are making financial decisions and we are trying to have those decisions last for a long time, if I make this investment, I want to hold it for 10, 20, 30 years. What we should really be asking ourselves is what is the event in the future that's going to cause me to regret making this decision? And because what I want to do is I want to not reverse many financial decisions. I want to make a decision that I'm going to stick with for a very long period of time. So if I were to make an investment and then it fell 30%, and I would regret making that investment because that decline would hurt me so bad. That's the situation that I want to avoid. So I just want to know what is my tolerance for regret, whether that is regretting market volatility that I experienced, whether that is regretting working too hard in my career and not spending enough time with my kids out here, whatever it might be, I want to have as few regrets as possible. And everyone's propensity for regret is different. The things that I regret might be different from the things that you regret. So you really have to be introspective about who you are and try to just pay attention to what you personally enjoy in life, not other people, but just you personally, to try to figure out what you're going to regret. Jeff Bezos has this great framework in life where he says every decision that he makes is trying to picture himself on his deathbed, hopefully, 40, 50 years from now, and having as few regrets as possible. That's every decision that he makes in life. That was why he started Amazon, is because he knew if he did not try it, he would eventually regret it. And so I think if you go through making a lot of financial decisions with that similar framework, just what are the regrets that I'm going to have? And I'll tell you how this can be different. For a lot of people, they would regret if they were not taking big risks. They would regret that. Jeff Bezos kind of fell into that category. A lot of people would regret if they did take a big risk and it backfired. That's what they would regret. So people will regret very different things. But I think just using that really simple framework when you're making these decisions, what am I going to regret in the future? And how can I avoid that is a really powerful way to make financial decisions.
You talk about how the personal aspect of personal finance is so important. How can that inform the role of financial advisors in a world where access to financial products has become so easy and widespread?
Well, here's what's really important is that just understanding that everyone is a product of their own past. And since we all have different paths, everyone thinks about risk and opportunity and greed and fear a little bit differently. I mean, what I've experienced growing up in my generation in the United States is very different from what other people in other generations in other countries have experienced. Everyone has their own little unique view of how the world works based off of their own experiences. If you grew up during the Great Depression, You're going to think about investing very differently from someone who grew up when the economy was really strong. If you grew up in Germany in the 1940s, you think about catastrophe and destruction in much different terms than I do. So everyone is a product of their own past. And because of that, we're all very different. And I think this is really important for financial advisors and individuals as well to realize that when everyone thinks about risk and opportunity through a different lens, there is no one right answer for how you should invest your money, for how you should manage your money. It's different for everyone. And people who are the same age, the same income, the same education, can and do come to totally different conclusions over what is the best thing to do with their money. And this is true for myself. I've just realized over the years that I have a slightly lower risk tolerance than other people of my age and income. It's not dramatically lower, but just a little bit lower than other people of my age and income. And rather than trying to fix that or trying to find a solution for, to get around that, I just embrace that that's who I am. That's just, for whatever reason, that's just how I'm wired. And so that's might be different from you, might be different from someone else. So realizing that everyone is a product of their own past and everyone has a different view of risk and opportunity is so important in investing. I think we are taught investing like it's math. And in math, there's one right answer for everyone. It doesn't matter how old you are or where you're from, 2 + 2 = 4 for everyone. That's what math is. And investing is just not like that. It's not math. It's psychology. And I think we should just embrace that there is no one right answer for how you should manage your money. Everyone is a little bit different, and you should just manage your money for what makes you happy, for what aligns with your goals, for aligns with your risk tolerance, even if it's different from how other people manage their own money.
You also talk about how dangerous it is the idea that an asset has one right price, and that can get investors into a lot of trouble. Why is that?
Well, it's the observation that investors play very different games, by which I mean in the stock market, there are day traders who are just concerned about what the price is going to do today. And then there are endowments that have a century-long time horizon and everything in between. And so even though they're all buying the same stocks, they're buying Apple stock, let's say, they're playing completely different games. And a lot of times what happens in the market is the daily price is being set by someone who's playing a different game than you are. Like if you go back to the late 1990s during the big technology bubble, a lot of what was moving the price of stocks and why the stock prices were going up is because day traders were pushing the prices up. And to them, it did not matter at all that these companies were overvalued because they were not going to hold them for the long term. All they cared about was that the price was going to go up between now and lunchtime. That was all they cared about. So for them, the rising prices made perfect sense for that game, for the game that they were playing. The problem came when, if you were a long-term investor, you looked at that price going up and you said, oh, maybe this is relevant to me. Maybe this shows that these companies are so great and I should be buying the stock too. The price was going up because people who were playing a different game than you were pushing the price up. So I think realizing that there is not one rational price for all investors, that a price and news and information that is relevant to one investor can be totally irrelevant to another is so important. And what this comes down to is just trying to define your own game as an investor. What game are you playing? What game am I playing? Few investors do that. They just kind of assume like I'm an investor trying to make money. That's how they define it. But everyone's playing a different game with a different time horizon, different rules. And I think you need to go out of your way to define what game you're playing. And once you do that, then so much of the news and information that is published every day in the stock market is not relevant to you. Maybe it's relevant to someone else, but it's not relevant to your game. So my game, I'll tell you, is I'm a passive investor who's trying to invest for the next 40 or 50 years. That's it. That's what I'm trying. That's the game that I'm playing. And therefore, so much information in the daily stock market about individual companies, about even like what the economy is going to do this year, I find interesting, but it's not relevant to my game. And once you define your game, then you can really filter out 99% of the noise and only pay attention to things that are relevant to the game that you are playing.
People always want to have the highest return and are often willing to take risks that will end up biting them. What are your tips for investors being, as you say, financially unbreakable?
I think you have to realize that most of what matters during your lifetime as an investor is how you behave when the world is falling apart. There's a great quote from Napoleon who was once asked the definition of a military genius. And Napoleon said, a military genius is the man who can do the average thing when everyone else around him is losing his mind. And I think it's the exact same in investing. Like that's the investing skill, is keeping your head on straight when the world is falling apart. That matters more than anything you do during during good times when the market is rising. It's just how you behave when things get crazy. And I think if you view it through that lens, then the idea of taking the biggest risks to earn the most money kind of falls apart for most people, because the biggest risk is probably going to be the investment, the asset that you're most likely to abandon when things are getting crazy, or the asset that fails when things are getting crazy. This just gets back to if you can earn average returns for an above average period of time, that is how you are going to outperform over the long term, rather than needing to take huge risks in the short run that you might not be able to hold either financially or psychologically. You just get scared out of it. That would be how I would view that. It's always the case too, the people who take huge risks that end up working out are the ones you're going to hear about in the news and on social media. The people who put, this is a true story. Someone put $8,000 in a cryptocurrency called Shiba Inu last summer that is currently worth $5 billion. $8,000 to $5 billion. That's a true story. Those are always the stories that you hear about in the news and on social media, and me telling you about. For every one of those, there are 10,000 stories of people who lost everything that you never hear about. And so the idea of taking huge risks to earn a lot of money is possible. I just don't think it's a very wise path to go on if there is an alternative, which is taking average risks for an above average period of time that is available to everyone, that increases the odds of actually getting to your goal so much better than you could by taking huge risks that are likely to wipe you out.
Another point that is very interesting in your book is that when you think about very successful people like Ben Graham or Warren Buffett, we should look at big overall behavior cues instead of trying to emulate the exact details of what they did. Why is that?
One is that the world changes over time. The global economy and stock market today is very different than it was in the 1960s or the 1930s. The makeup of industries and how technology works completely changed over time. So we should not go back and look at what Warren Buffett did in the 1960s or what Ben Graham did in the 1930s and try to emulate that. It's a completely different world. What worked back then does not necessarily work today at like the technical nitty gritty level. Like what stocks did they buy? What formulas did they use to buy those stocks? Like that stuff changes over time. So the technical details of what worked then are not relevant anymore. But the really big behavioral attributes that led to their success, that stuff does not change over time. There's a great quote from Voltaire where he says, history never repeats itself, but man always does. Like the technical details never repeat themselves, but the behaviors always repeat themselves. So what can we learn from Ben Graham and Warren Buffett? It's not the technical details about how they valued stocks back in the day. It's details about their temperament and how they think about risk and kind of the high level philosophical views that are still relevant today. So things about their patience, about how they react to market declines and how they keep calm during market declines, that stuff is timeless. But I think the very specific details about, Ben Graham buying stocks for less than 1.2 times book value and using these specific formulas that identified cheap stocks, that stuff changes over time. Ben Graham himself, in an interview in, I think, 1974, just before he died, was asked if he still uses the formulas that he wrote about in the 1930s and 40s. And he said no. He said the world had changed over time to such an extent that he didn't think that picking individual stocks was going to be as lucrative as it was when he wrote The Intelligent Investor in the 1930s and 40s. So even for Ben Graham himself, there was an acknowledgement that the world had changed. And he died 50 years ago. Like it had already changed back then. And now we've had 50 years of innovation and evolution since then. So there is so much to learn from Ben Graham and Warren Buffett, but you have to be careful that what you are learning is the really high level things about how they behave versus the technical details about what they did half a century ago.
And actually, I think another great thing to learn from them, especially Buffett, is their ability to evolve, right? To themselves learn. Buffett used to reject technological companies, and then he became the biggest investor in Apple. I think that's also very interesting.
I think it's probably true that Buffett has earned more money from technology stocks than anyone else in history. He's made so much money on Apple, like in dollar terms, he's probably now the most successful technology investor in history. And it's true that too, if you look at how he invested, his techniques for investing 50 years ago, they're totally different from today. And that to me is one of the marks of a great investor, is that they can thrive and succeed in various different environments. They're not just a product of being in the right place at the right time. They can change and evolve as they go to adapt to the new realities. I hope that will be true for myself as well, that, I have my investing philosophy today. I'm a passive investor. I invest in income in index funds. This is what I do. That might change in the future. I don't want to be so dogmatic and so stubborn in my views that I anchor to that if that strategy might stop working. And I think there's a big difference between patience and stubbornness. Patience is, just letting your strategy work out over time. Stubbornness is not acknowledging that your strategy is kind of anchored to the past that no longer exists. It's a really subtle difference, and it's hard to tell the difference between the two. But the people who do very well over time, like Warren Buffett, of course, understand the difference between patience and stubbornness.
Let's say that you invest so well that you're able to retire much earlier than you planned. Should you? How should one stop working or think about stopping working?
I think most people, not everyone, but most people that are lucky enough to achieve early retirement get bored really quickly. And they realize that, hey, it's great that I don't need to work anymore, but actually my work was giving me a sense of purpose and mental stimulation that I now miss. Again, that's not everyone, but I would say 90% of the people who I know who have fallen into the FIRE movement, financial independence, retire early, it's not that they regret it, but they realize that it's very different than they once thought. So I think rather than saying, I'm going to retire and I'm going to play golf and watch TV and sleep till noon every day, I think rather than doing that, I think the goal is to say that I want to be financially independent, but I'm still going to work, but I'm going to choose the work that I want to do at the company that I want to work for on my own terms, on my own schedule. Maybe you're a consultant, maybe you become an artist, whatever it might be. I think having that stimulation and structure and purpose in your life is so important to most people that it's easy to overlook. And for most people, taking a month off, maybe 6 months off, that can be great. But if you're going to retire when you're 32 and just hang out and sit on the couch for the rest of your life, that's a recipe for not only boredom but depression at that point. So I think that is really easy to overlook in the retiring early movement, is that it's not necessarily that you're going to quit your job. It's that you're only going to focus on work that you really value and like doing and enjoy doing over time.
That's great. How do you define success in your life?
For me personally, it's just, do I have the independence and the autonomy to spend time with my family and to take care of my family and to spend time with the people who I admire, my friends that I like spending time with? Can I wake up every day and open my eyes in bed and say, I can do whatever I want today? That to me is success. And most days I'm going to wake up and say, what I want to do today is go to work. That's what I want to do. I want to go do the best work that I can. So having independence does not mean necessarily that you don't work anymore. It's just doing things on your own terms. That to me is the most important. The other thing is, do the people who I really admire in life, do I have their respect? Not necessarily the respect from the strangers on social media or what it might be, but do the 5 or 10 people who are really important to me, do I have their respect? Like that's the most important by far. So those are the two things. If you have independence to do what you want, and the people who you really love and admire you back, that's to me is like, that checks 90% of the boxes of success in life for me. But of course, it's different for everyone. Everyone's going to have a different definition of success. But those are the two things that I really try to focus on and measure.
That's great. And Morgan, tell me about your next projects. What are you up to right now?
I'm always I like reading about topics that have nothing to do with investing to try to learn some investing insight from that. So I never read investing books. I never read books about the economy. I like reading about history and biology and evolution and biographies and those kind of things. And I just try to piece together, how do people think? How do people think about risk and opportunity, and trying to tie that back to investing and the economy. So the next project that I'm working on is trying to figure out, what are the behaviors across investors that never change? How do investors behave today? That was true 100 years ago. It'll be true 100 years from now. Never changes over time. And just documenting those behaviors and turning that into my next book. That's what I'm working on right now.
That's great. Morgan, it was wonderful talking to you. Thank you very much for participating.
This has been a lot of fun. Thank you so much.
E com essa aula do Morgan Housel, a gente encerra o BDR Investor Day. Quero agradecer a todo mundo que acompanhou, agradecer a B3, todos os participantes que toparam participar dos painéis que aconteceram ao longo do dia inteiro. Foram mais de 10 horas de conteúdo. E se você perdeu algum dos painéis ou quer assistir de novo, todos eles vão estar disponíveis. É só você deixar o e-mail no formulário que está aí abaixo do vídeo para você receber direto na sua caixa de e-mail e assistir quando quiser. Foi muito conteúdo, vale a pena ver de novo, então fica aí a dica para todo mundo que acompanhou esses painéis. Eu me despeço aqui, então tenham todos um bom fim de noite e até a próxima.